Sivaram joins us, Investment Director with Enam Holdings. Sridhar, hi, good to have you back. Thank you for joining us.
Thanks for inviting.
How would you paint the scenario for us?
Our broad view for the market is that in the short term we could see a time correction or maybe a price correction. More from the fact that the macro data, both in the US and in India, especially on the inflation side, still is looking a bit sticky. So for the US, I don't see it going below 2, at least in the next 6 to 8 months. And even for us to go below 4, I don't see it almost for a year. I mean, in fact, this month, the number that we'll get for the previous month is going to be very scary. It could be
That's tomato and onion, no?
Whichever way it is. I mean, 50% of CPI is food.
Yeah.
And if RBI is going to look at only CPI for their rates, then that's what we have to worry about. It's a different debate whether monetary policy can really control food prices, but that's what we have to worry about, right? So I don't see any rate cut. I don't see a rate hike because of tomatoes, but I don't see a rate cut for at least for next.
Were markets betting on a rate cut?
I don't think so. I'm not very sure if the market's betting. So I think we are betting on a status quo unless this continues and RBI tightens not in terms of rate but in terms of liquidity. That could have some impact. But it does have an impact, right? I mean, if your interest rates are higher for longer, then it has an impact on the market. So we see it could be a time correction or it could be some pockets where excesses are there. We could see some correction there. Worry will be more what happens in the US because just 7 stocks are holding the market there. The broader market hasn't done very well there. And the more you read how credit card interest rates have gone up, mortgage rates are almost 7.5, very close to where India is right now, and how that plays out, those will be the larger worries. I'm not an expert there, but whatever I read, it looks like it's a space to watch.
So if the US inflation is a concern, which in a sense is the biggest moving part, yields are at 4%, the peak yield in 2022 was 4.4, then why do you expect markets will be range bound with a time-wise correction? Why can it not be a slam dunk like a 10%, 15% sell-off?
So I take some solace from the fact that in March we saw a big crisis, especially in the US with the smaller bank issues that we faced there, and our markets held reasonably well. We did correct, but it wasn't like our banks were down 20% or anything of that sort. Many of the emerging markets had issues. Like if you see Taiwan, Korea, they corrected very sharply at that time. We held reasonably well. So I would say India actually is sort of a defensive market. So if you see even for the current year, India has done what, 6-7% in dollar terms. Emerging markets are up 6-7%. And look at other markets, Korea, Taiwan, Brazil, all are up 15-16%. So I would say the defensive nature of India gives me the confidence that even if we see some sort of a crisis there, we may see some correction, but it may not be that sharp.
You know, no pun intended, but you look at India as a defensive market, but in India, defense stocks are trading at consumer stocks. How strange is that, right?
We like that space. So
that's why I bought into defense.
Complaining at all.
That's why I bought defense.
Yes.
Why do you like that space? You know, we've been debating this now. That look great big picture. I read a just flash which has hit my mailbox that the Indian government has now instructed Indian military that you even cannot use Chinese parts for the drone replacement. But defense orders are long cycle orders, 5-year, 10-year. You get an order to make an aeroplane to deliver in 7, 8, 10 years. Aren't markets pricing in too much here? Markets have started pricing these stocks like ABBs and Siemens of the world. Isn't there a disconnect?
So I think there's some disconnect in some stocks, but I would also want to highlight that the offset clause is also making a big difference. I mean, this has been there for many years that if we give an order to an overseas company, 30% has to be manufactured in India. That is being enforced only in the last 4-5 years. The impact of that we are seeing on Indian companies is huge.
And servicing the drones and servicing the planes.
Once you have the offset partner in India, then servicing of that equipment automatically comes into these entities, and we are seeing many of these companies seeing service income going up significantly. So apart from say the most intelligent part of say a drone or say a radar, which they may have some sort of the knowledge may not be in India, most of the other parts they are servicing. So I'm saying it's a whole ecosystem, the whole thing has changed over the last 4-5 years. So I think what the market is suggesting is good. Whether the valuations are right for today, I'm not sure. But if I extrapolate it for next 2 years and if everything plays out well, then there may be a story. So we are long some of these stocks. Some of them may not have earnings exactly as we expected. As you said, these are long gestation orders. Not all the orders are executed at the time that is expected. So there's some patience is required in this. We
Where else are you long?
Financials, the very obvious one.
That's 2 years ago.
Yeah. I think, see, they have not participated. To be fair, the top 5, 6 financials, if you see, they're up for maybe 5, 6% for the year. They've hardly done much. Earnings have been very good. So I don't see complaint as far as earnings is concerned. Maybe margins have peaked out, but credit costs have behaved very well. So I don't think we are worried about 2 quarters here and there. We are seeing the longer picture or the next 2 years, 3 years. If India grows, say even at 6-7% from a GDP standpoint, these stocks have a long way to go.
So financials is the consensus trade, right? Consensus overweight. Yeah. What's the most underrated sector as per you where you would like to make a contra bet now?
So I think contra bet, we've been long the PSUs generally. PSU banks, PSUs, and that trade has played very well. We are still very bullish on the PSU banks given the earnings. I mean, that's a segment where people, earlier there was a consensus negative. Yeah. Now I would say it's a 50-50. Where some people.
But even the lower order banks and not just the large bank SBI?
Yeah. So we're quite bullish on, there are just 4-5 banks investable in the PSU basket.
Should I start taking names and you will say no for them and yes for the ones?
3 of them, barring 1 or 2, the rest are investable actually. And they look reasonably good. Look at their earnings. I mean, they're still trading at 4-5 PE.
But why were NIMs were down? I looked at SBI and BOB, NIMs were down. Managements are saying that you hit a peak in terms of the credit growth. So if the business is not going to be in the expansionary mode, does it make sense just to look at value and then buy them?
So I think over concentration on NIM also is an issue. So what you have to look at is what is the operating profit growth. So you look at the operating profit growth is still growing at say 10 to 15%. Yeah. Your credit cost is broadly stable or down. See, keep in mind that credit
ROAs are also going higher.
So you keep in mind that private sector credit costs have already come down substantially. They are at on an annualized basis 50-60 basis points. Most of the PSU banks are, barring SBI, most of the PSU banks are in the 1 to 1.5% range in the credit cost. That can still come down to say below 1%. So what you're seeing is your operating profit growth is say 15%. Your PAT growth is almost 50-60% even now. And that's coming predominantly because of this reduction that we are seeing in the credit cost. And we think that will continue to play. Some of these banks are trading at say 5% dividend yield now because they have to pay 20-25% of the profits as dividend. So, I mean, whichever way I see, it looks an interesting space. We think that a lot of the re-rating has already happened. From here on, even if you get earnings growth returns, that itself could be 20-25%. So, I mean, that's how I'm seeing it. Only time will tell whether we are right or wrong.
What about the entire auto space? For instance, we had the management of M&M right here in our studios yesterday, and they alluded to the fact that the premium end is seeing a lot of demand, and whereas the mid isn't seeing quite as much volume growth. Do you think that premiumization factor across the board, be it even autos, consumption, all of that is likely to stand out?
Yeah, so we are in the K-shaped recovery camp. We've seen right from, say, autos to watches to hotels to airlines to discretionary spending. Wherever you have there are pockets of discretionary spending, stay at the higher end, not at the lower end of the bucket. So we like all stocks in the discretionary space which are slightly at the higher end of the bucket, which is on the higher end of the K-shaped K. So I think it's playing out right now. We think it may continue to play out for maybe another year. Maybe closer to elections, we'll see some more dole-outs and, maybe the post the monsoon, and if the rainfall is good and the crops are good, maybe things will change for the bottom of the pyramid. But right now, we prefer the discretionary at the higher end.
I haven't heard you speak about pharma at all. Is that a complete avoid for you? Whether
No,
diagnostics
actually,
or
pharma is a very stock specific. Even now, if you take the top 5 pharma stocks, out of that, 2-3 would have done very well, and you'll find 1 or 2 at the bottom in terms of, even if you look at Nifty, you'll have top performer and the bottom performer in the top
Both
10, you'll
from
see
Pharma.
Pharma there. So it's very difficult to give Pharma as a generic, and we don't talk stock specific, but we like some of the Pharma stocks, especially on the large cap where things are showing very promising growth in terms of the generic space and even non-generic.
You know, some of these new age tech companies, the results, really the proof is in the pudding. They're narrowing their losses, costs are under control. Does that change the case?
It does. So actually, in the last 6 months, we've been engaging with many of these new age companies, as we will put it. I mean, in 21, when they listed, we really didn't understand the valuation, the business model. And many of them didn't want to engage with smaller investors like us because a lot of the FIs were putting in money. Things have changed.
Small.
Yeah, I was just thinking small investors like you.
Things have changed now. I mean, they want to meet us and they want to discuss the business model. Also, the business model,
Which
to be
is this
fair,
company
has
which
changed.
does not want to meet Enam Group? I want to find out.
It does happen. It does happen. No, but now the business models have changed. So if you see, all of them are talking path to profitability, and we can clearly see path to profitability in many of them. And we've changed our views and we've invested in a few of them.
Which ones?
We'll tell you after the show.
It's simple to look at where the matrix there is: financial services and consumer tech.
Yeah.
And so, consumer tech or financial services?
Both actually. Financial technology, we are clearly seeing path to profitability. Business models have changed.
You can just try to narrow down that list.
Paytm, Zomato,
Clearly changed.
PB Fintech.
But even on the consumer, in some cases the valuations are still high, but at least there is a business model which is.
How do you value them? Because there is no proof.
Yeah.
If you start looking at EPS, there is not going to be an EPS benchmark, even if they turn profitable.
Yeah,
How do you value them?
So you see competitive dynamics in some of them, whether there are how many players are there, how many people are competing, and try to figure out if required, can they turn profitable by charging more from customers. So I think it's at the end of the game, at some point it's more an art than a science. But at least the valuations have corrected. Earlier it was a complete art. You had no clue how to value them. Now I would say that there is some method in the madness.
They've realized that when you in the auction market, the rules are different. That's what I think promoter realization is, that when two smart guys are selling in the private equity market, valuations are different. When the auction market helps you discover it, the rules of the change are different. I
Yeah.
mean, you cannot play volleyball in a cricket match.
Yeah,
That is what I
reality
think
kicks in.
what has changed. You know, when Manish Bhai was here, we spoke about manufacturing. And there is a lot of way in which you can look at manufacturing.
Yeah.
Pharma is manufacturing, EMS is manufacturing, auto ancillary is manufacturing. He gives this example that how when Maruti came, it created auto ancillary. When GE came, it created IT. Now Apple has come. What happens because of that? And then he stopped.
Yeah,
So why
I
don't you
think
take it
that's-
forward?
I think that's the crux, that EMS as a space, we think will evolve into a massive manufacturing opportunity for India. If Apple wants to export from 10 billion to 100 billion over the next 2-3 years, a lot of it may be in the private space, but it's going to create an ecosystem for the hub, the entire hub for manufacturing of, say, Apple phones. Now, today maybe only 10% is value addition in India, so 90% is import and you are just assembling. Over time, this 10 is expected to go to 40-50%. That's when the game changes. That if India starts to manufacture more and more parts for the iPhone or for the iPad or for whatever Apple is manufacturing and exporting. And we think that will happen. We saw that with autos also, that when we started in the 80s or 85, it was more an assembly unit.
Yeah.
And over the years now, I think almost 80-85% is manufactured in India. So we think that this is a space worth watching. Not too many
interested?
companies are there. I mean, today you're talking of 5-6 companies, at best 8,000-9,000 crore market cap. Some of them are even smaller. But over a period, we think that this space will, develop into a fairly significant opportunity for investors.
Are you Sridhar Sivaram? Because you like banks, you like pharma, you like manufacturing, you like PSU, you like defense.
I don't like IT.
Oh, you don't like IT. Why is that? Now Sridhar Sivaram is back. Why is
So
that?
I think IT is getting disrupted. I mean, this is my personal view.
of
Okay,
course,
we
of
have
course.
split view in our
Yeah,
office
of course.
itself.
That's how investing
So,
works.
yeah.
You know, it's so beautiful if you look at the Enam and, being an old-timer market commentator, you know how things work. There are folks within Enam, they have a different view. There are, folks within Enam, they're selling to each other. That's how I think markets are. Buyer and the seller,
Yeah,
they both think they're right.
Exactly. So
Okay.
my view is that Indian IT sector is getting disrupted by generative AI. 30 to 35% of the employees are in the 1 to 3 year experience bracket.
Just say that again. 30 to 35 is getting disrupted.
Of the employees are in the
1 to 3
years.
years.
So they are basically the freshers who come in.
Yeah.
And Mohandas Pai has been very vocal about the fact that freshers in TCS, Infosys hardly get 4.5 lakh salary per year. So they are basically the coders, the low-end job that we are doing. We know that generative AI coding has become the easiest thing. What 10 people could do, one person can do now, and that too at a much faster pace. So what happens if the number of employees that tech companies in India they need is much lesser? If your business model is number of employees into time spent, which is how you generate your revenues.
That's a calculation.
So your revenues are going to come down. The flip side is your productivity is going to go up. But my point is that if my client knows I'm using generative AI for some part, will he give me the same rate? Possibly not. So I think this is a space which will first get disrupted. There's also opportunity for AI, which is companies wanting to integrate generative AI into their business model. My view is that these companies first get disrupted where they will see slower and lower growth in terms of revenues. And then as they evolve their business model, we'll find winners from there. Whoever is able to disrupt and adapt better will possibly the winner. And a large part will see some sort of disruption. So what you should track is number of employees that people are adding. So look at Infosys. Last 2 quarters, they've had 12,000 lesser software employees. So if you take say 3,50,000 as the employee base, and out of that 25, say 30% is what I'm talking about. So that's like a 1 lakh employee base may already 12,000 you've reduced in 6 months. So that's almost like an annualized basis 25% reduction. I'm saying you cannot, I'm just giving a rough number.
There is a disruptive element at play.
Correct.
Whether it's a tailwind or headwind, we'll figure it out. For right now,
this is my view that I think it is disruptive. Some others feel this is also an opportunity. But my view is that I would rather be on the sideline right now and see how this disruption plays and then take it forward when I have a clear view.
Are you using ChatGPT a lot right
I
now?
do use, in fact, I am also a photographer. I use Adobe and the generative AI and the improvements that have come because what I can do with on a Photoshop or on a Lightroom is significantly
I don't even think you need to go to the jungle anymore.
Still need to go for other reasons, but at least it's helping me in terms of process some of these photographs.
Yeah.
Well, so nice to have you.
Thank you very much for inviting me.
Thank you for joining us. What do we have in the market?